The Senate has completed its business for today. Senators will be back in their districts during next week's recess.
Good morning, ladies and gentlemen. Thank you for coming this morning. Welcome to Marymount. It's wonderful to have you all here. I'd like to welcome you to the School of Business Administration in our Y2K seminar series. We've launched this program as a means of increasing the visibility of Marymount in the local business community and as a way of providing enhanced services to our alumni. My name is Stuart Christ. I'm a member of the advisory board here and a past president of the Alumni Association. We welcome you this morning. It's very, very heartening to have you here. And it's now my honor to introduce you to the president of Marymount University, Sister Amar Gallagher. Sister.
Thank you very much, Stuart. And thank you all very much for coming this morning. It is a nice, bright, early morning, and we're just thrilled to have so many of you with us this morning. And of course, I'd like to extend a special welcome to our guest speaker this morning, Al Berkley, the president of NASDAQ stock market rather. These are certainly heady days for NASDAQ, so we truly appreciate the opportunity of having you with us, considering all your tremendous schedule. This morning, I would like to just mention a couple of exciting things at Marymount, and if I may just say that we are delighted to be celebrating your presence here this morning, Mr. Berkley, but we are also celebrating a couple of other wonderful occasions here at Marymount. We're celebrating, as many of you know, our 50th anniversary of the founding of Marymount University as a Catholic institution of higher education. There are so many things that we have been celebrating this year that I won't go into them all, but one of them I would like to emphasize with everyone this morning, and that is Marymount received our first endowed chair. For the first time, Marymount University has been given an endowed chair, and I'm thrilled and proud to announce that it is a chair of ethics. You all know that Marymount emphasizes ethics and values across our curriculum, so we're particularly thrilled that such a meaningful gift would be given to Marymount as part of our 50th year celebration. We also celebrate, I assure you, our wonderful alumni. We're very proud of you and particularly pleased with your dedication and your support. And I'd particularly like to mention Michael Kelly. He has been a great supporter and a very dedicated alum, and it's because of Michael that we have Mr. Berkley here this morning. We also are very pleased that Stuart is with us this morning, and I will turn the podium back to Stuart, and thank you, Stuart, so very much.
Thank you, Sister. Mr. Al Berkley was appointed the president of the NASDAQ stock market on May 9th, 1996. Prior to joining NASDAQ, Mr. Berkley was a managing director and senior banker in the corporate finance department of Alex. Brown & Sons, where his primary expertise involved large computer software and electronic commerce companies. Mr. Berkley joined Alex. Brown & Sons in 1972 as a research analyst. Mr. Berkley was a managing director, he became a general partner in 1983. From 85 to 87, he served as head of information services. In that capacity, he was responsible for all corporate technology, including the firm's back office and front office. Mr. Berkley then moved to Alex. Brown's merger and acquisitions department, where from 87 to 89, he helped to develop the firm's technology practice. From 89 to 91, Al took a leave of absence from Alex. Brown and joined Safeguard Scientifics, where he served on its executive committee and as chairman of a number of its subsidiaries, including Rabbit Software and Micro Decisionware. Mr. Berkley served as a captain in the United States Air Force from 1968 to 1972. He's a graduate of the Wharton School at the University of Pennsylvania, receiving his MBA in 1968, and the University of Virginia, where he received his BA in 1966. A few notes regarding NASDAQ during Al's tenure. In 1997, NASDAQ implemented the SEC's order handling rules, incorporating ECNs into the NASDAQ market structure. In 1998, the NASD and Amex merged, creating the NASDAQ Amex Market Group. In 1999, the Optimark trading system was introduced. Just about a week ago, March 1st, 2000, NASDAQ volume exceeded 2.2 billion shares in one day, compared to an average of 1 billion for the first 2 months of 99, an average of 802 million shares in 1998, and 648 million in 97. In 1998, the NASDAQ composite was up nearly 40% over 97, and is now up 123% over the end of 98. And very importantly for the local economy, NASDAQ is a local organization. And believe me that many small, dynamic, and aggressive local technology companies now dream of one day being listed on the NASDAQ. This seminar series is meant to be forward-looking, exploring the need for management to accept the challenge and provide insightful leadership. In this spring seminar, Al will address a vision for the markets. Ladies and gentlemen, Mr. Al Berkley.
Thank you very much for having me. I love these long trips from downtown Washington to Northern Virginia. I don't know if you all really appreciate what's going on in Northern Virginia, but it's reaching that wonderful state of sustained, accelerated growth. It's the same sort of phenomenon that occurred a few years ago in Silicon Valley. And you're seeing this tremendous vibrancy and new companies starting and risks being taken on new technologies and jobs being created. Of course, you see the flip side of that, which is traffic congestion. But basically, it's a symptom of some very good, strong things that are going on. Most of what we're trying to accomplish in the NASDAQ stock market is epitomized in what's happening here in Northern Virginia. I don't know how much you know about the NASDAQ, but we're all about the opportunity for entrepreneurs to find investors on a fair and level playing field. America has the most extraordinary approach to securities that has become the envy of the world. We base our whole market on disclosure. We require companies to file the material relevant facts about their business with the SEC. And we hold them to putting that information out there truthfully. And if they don't put it out truthfully, there is government investigations and penalties, and there can be private lawsuits. And it's proved to be a very effective balancing act. The heart of this system gets at what I was so pleased to hear you talk about, which was an emphasis on ethics. America's markets work because you can go to the market and believe and be assured that you're going to be dealt with fairly. You can look at the history of markets around the world as a tug-of-war between market insiders who would like you to have as little knowledge as possible and your own interest expressed typically through government policies saying that you need to be able to know what's happening. NASDAQ does two very simple, very basic things. We tell you what the price is if you want to buy shares in the next transaction, and we tell you what the last person paid. And that's really all we do. We put up the price of the available stock that you can buy next, and we tell you what the last person paid. And those two combinations, those two things, have really only been available since 1983. Isn't that incredible? We had, until 1983, we didn't necessarily tell you what the last person paid. We had what's called trade reporting forced on the markets in 1983. And it has profoundly influenced people's behavior because it adds to trust. It adds to the integrity of the market so that you can be sure that you're not paying if you don't want to pay, far away from what other people are paying. We give you the freedom to buy at any price you want, but we also give you the information to know what the other people are paying. These simple concepts are done over 1 million times a day. We have over 1 million transactions a day on the NASDAQ. And it has given this country the ability to allocate capital almost instantaneously on the fly. It means that we make decisions, millions of small decisions about what industries are going to get financed, what companies are going to get financed. It is the exact opposite end of the spectrum from the old 5-year plans that you had in the Soviet Union, where a central idea, where a central authority would say we're going to fund the steel industry, or we're going to fund the cooperative farms, or we're going to build televisions. In the United States, we make those decisions of what's going to be funded and what the cost of capital is going to be for each of those businesses literally 1 million times a day. And each person makes their own little decision and figures out where they want their risk and where they're willing to take a chance to get a reward. These are really profoundly important differences that we have in this country that's made these markets really the envy of the world. We get visitors at NASDAQ about every week or every 2 weeks, and they come and they say, how do we get one of these NASDAQs for our country? Now, what they really mean is, how do we get an entrepreneurial, risk-taking economy? We have about half of the population, about half of the households, in the United States own either an equity mutual fund or an equity directly. And they've made a decision to buy or sell that within the last 12 months. I'm not sure I know exactly the same ratios in Europe, but I've heard numbers between 12% and 19%. And the other day I heard a number of about 9% of households in Japan having an equity or an equity mutual fund. So you can see we are much more equity-oriented as a country. Now, there are a lot of cultural and historic reasons for this. We are benefited by not having had a war on our soil for over 140 years or so. And we've been able to build up a large capital base, and we have excess. And people are able to take that savings, that excess, and deploy it for gain. And equity has become the preferred method for doing that. So we have the capability to fund entrepreneurial new ventures. Now, many people ask me, what in the world is going on with all this internet funding? And I think that you have to look at this as being very similar to what happened when the railroads were introduced. Part of our economy is moving to a new, lower cost curve. Part of our economy, in this case, not the physical part that the railroads lowered the cost of moving, but the digital part, the information part, which the internet's lowering the cost of moving, is going to be profoundly cheaper. We're working hard to make sure that NASDAQ participates in lowering its costs, and I'll give you an example of what we've done there. When I came here in 1996, our cost for the most basic trading system that we have between two market makers was $2.50 a side. Today, for a high-volume user, it's 20 cents a side, and we're likely to drop that to 10 cents a side. So that these are orders of magnitude reductions. Now, the first price cut that we undertook was really quite frightening because we didn't know whether there was any price elasticity or not. We didn't know whether we were going to get any extra trades or whether we had just given up that amount of revenue. But we began to see the elasticity exert itself, and we began to see our trade counts climbing, and we realized that if we did everything we could to make it very, very low cost to trade, that savings would be competed through to the individual investor, and that's why you're able to see $6, $7, $8 commission costs on trades, some of which are up to 5,000 shares. So it's very, very inexpensive to access America's markets. The second thing we've done is through a rule interpretation that Bob Aber, the NASDAQ General Counsel, worked with us on in August of 1996. We've been able to allow firms to back the internet up to the firm's computers and give you what appears to be direct access. Bob came in with a question that was really quite simple. It's the simple ones that always get you, you know. The question had come in from a firm, and it was, does a human being have to look at every investor's order? And those of you who've been in the business or know much about the business will remember, like me, when I came into the business and out of the Air Force in 1972, I learned to fill out a purchase and sales ticket, and I learned to check whether the customer was a real customer and the stock was right, and they had the money in their account or the certificates, or how we were going to get those, and whether it was a legal sale. And I had to initial it, and I had to hand it to my boss, and he or she had to initial it, and then it had the right to go to the trading room and be acted upon. Well, we determined that if the computers did everything that the human beings would have done and kept a good record of it, that was probably a better record than we had with all these human beings involved. And so we now enable you to have what looks like instantaneous and immediate access to the market. This sense of immediacy and this sense of control is extremely popular with investors. And it has led to a lot of democratization of the market, a lot of participation by individuals. Now, you can argue whether this is good or bad. We do have, I think, three classes of participants in the NASDAQ. We have investors, we have speculators, and we have gamblers. Now, what's the difference? If you look at it, theoretically, and I'm going to give you two views of this, one an operations research view and another just sort of a practical view. An investor looks at the company and says, gee, I like their strategies, and I like their market position, and I like their products and their pricing and the way they're competing, and I'm going to put some money in that, and those managers' strategies are going to grow the value of that, and I'm going to come back sometime in the future, and I'm going to have something that's worth more, and I'll be able to sell it. The speculator looks around and says, gee, look what all those other people are investing in. I think I'll get in that game too. It's sort of a beauty contest, sort of a musical chairs game. They think that they'll get it in play, even though they know there's risk. And the gamblers take the attitude, well, hey, that fellow Burt Malkiel up at Princeton has said that this is all a random walk anyway. Let me pull the slot by buying something and see if it goes up or goes down. And these transaction costs are so low that I can make a little money if it goes up just a little bit, and I can get out very quickly. Now, if you're from the operations research world, you will recognize immediately that we're talking about the three basic strategic choices: games of chance, games of skill, and games of strategy. So the games of chance work in a random walk environment. The games of strategy and the games of skill also work. So we have these three different groups of people. The risk to the public and the risk to trust, your trust in the market, is a complicated balance for us, because we have instincts to protect innocence, and we have political pressure to protect naive participants. But we also have, on the one hand, people's ability to say, well, I'm an adult. I want to risk my own money. It's none of your business, market, how I place my investments. And we also have, we also have the institutional investors who say, look, I'm a big boy and I want to operate this way, and what I'm doing, even though I'm doing it very rapidly, and even though it might cause a lot of volatility in the market, is part of the functioning of a market, and supply and demand should damp out any excesses. Well, we're working very closely with the SEC and with the state securities commissioners, and indeed with the United States Postal Service and the Federal Bureau of Investigation, to make sure that we have a level playing field that's fair and allows the right balance of these personal freedoms versus the protection that we think we need to afford. People who are drawn to these markets because they're in the media a lot, because they're hearing about stock price rises that are relatively spectacular on any historical basis. And we struggle hard because there are new gray areas of concern. We've never had chat rooms before. The law is struggling to figure out the balance between your personal freedom to say what you want and your responsibility not to yell fire in a crowded auditorium, not to say something that's wrong that fools other people. And I was, on the one hand, distressed to see the law students caught with a chat room scam a week or so ago. How many of you read about that in the paper? You probably remember it. Local event. On the other hand, I was delighted because I happen to know the folks at the SEC that are working on that, and I'm glad they found some high visibility ways of showing would-be young people who say, well, I'll just get in a chat room. These are people in their 20s. I'll just get in a chat room. I'll buy some stock nobody's heard of. I'll say wonderful things about it, and I'll laugh all the way to the bank while I'm selling and other people are buying based on my rumors. We're trying to find the right balance as the law seeks to catch up with what new technologies have made possible. It's always been possible to tout a stock fraudulently, but it's now possible to tout it globally instantaneously. And remember those gamblers, speculators, and investors? A lot of people will say, I know this is a scam, but I want to play anyway. I think I can probably get in and get out and make money while I'm watching somebody else try to take advantage of the last person in, the musical chairs effect. So we're working hard with the NASD regulation, with the SEC, and indeed with the media on trying to get the word out. We really like it when the media digs into these issues and makes people aware of the fact that amateurs are not likely to win in this environment if they're in and out of the market too quickly. Well, let me stop here and let me take your questions, because I like to give rather historical, I like to give a lot of historical lead into answers of questions, and it often takes a little bit longer than typical Q&A periods. Does anybody have, yeah, in the back?
Currently, about 35 percentage points explain the difference between the gains in the NASDAQ composite versus the loss in the Dow 30. And we're entering our 108th month consecutive of expansionary period. And there was a rather poignant article in the Wall Street Journal yesterday talking about how the Dow 30 old economy stocks have fallen out of favor with investors. Do you believe that the NASDAQ composite is a better judge of how the economy is moving forward and how successful we are being as compared to the Dow 30?
I think that the NASDAQ 100 is highly weighted to its largest companies. This is a market capitalization weighted index. The largest Microsofts and Ciscos and Dells account for a hugely disproportionate share of the gain in the NASDAQ 100. I think that the NASDAQ reflects the growth of technology in our economy better than the other indices, but I'm not sure that it reflects the whole economy better. There's a multiplier going on here. Equity investments are all about growth. The only reason that you go into an equity investment, in theory, is to get growth. And because the technologies are creating lower costs and therefore attracting a lot of purchases, the revenues going into technology companies are growing very quickly, creating the opportunity for the profits to grow very quickly. You're having a lot of funds flow into technology equities. And lately in the biotech industry's begun to come back into favor because they're actually coming through that long period of research and discovery and producing new things that are having profound impacts on disease. I think that we're not going to go back to valuing the older industries. There will be newer segments of these new industries which will shred out and grow even faster. You're watching, it's not your traditional classic sector rotation on a single cost curve. You're watching part of the economy move to a new cost curve. And there's a land rush going on to stake out space on that new cost curve. It's going to profoundly affect education. I'm on the board of Johns Hopkins, and I was talking to John Palms, who's president of the University of South Carolina the other day, about what does it mean for a university to have instant access to the world? And what does it mean for a student who wants to get educated, and the fundamental basis of that education is what they really know, not where they got their degree? And can they get a better education by taking this course from this university and this course from that university, all on their same PC? And then what's the question about human interaction in the classroom, and where does the role of human interaction with a mentoring professor come into the educational mix? I think we're going to find these balances between high tech and high touch in the business of education, just like we're finding them in every other business. Medicine's a great example of that. Where does technology find its increasingly proper role, and where does human contact, which is also incredibly important in medicine, find the right balance? So it's a long answer to your question, and I'm not sure I've really answered your question, but I think you can understand what's happening better if you understand that we're moving part of our economy to a totally new and lower cost curve, and it's going to profoundly change the businesses that are touched by it.
This spring seminar brings together people from the business community and higher education, and you've alluded to the connection between them. Can you share with us some ideas of how you think business and higher education can collaborate in the future more effectively?
Yes, I think that I was talking earlier in the reception a little bit about this. I think that the great need of business is to find a way to use the educational industry for where it can do what it does best. And by the way, I think there's several dimensions to that. I think that the ethics issue is better dealt with in an educational environment, although I think it has to be dealt with within individual corporations and the culture of individual corporations, but it needs to be reinforced. It needs to come in very, very early in the formation of a person's values and the training they get. I think that the practical, almost vocational skills of learning the vocabulary and the structure of an industry is useful, but it's not nearly as important in the long run as issues like how to learn, or how to think about ethics, or how to connect with, indeed to network with other people outside of your own company to grow your industry knowledge. So I think that there are going to be many collaborations. You're seeing some interesting things happen as the education industry, I think, has not kept up with some of the specific needs of the business community, and you're seeing businesses form their own virtual universities. Cisco, for example, has a tremendously powerful web-based training program for people who would like to learn about becoming internet technicians. Well, this is a smart thing from Cisco's point of view because they're training people to use Cisco equipment. But it also is creating in any library in any part of the world where there's an internet connection, access to essentially high-quality technical education. I talked out in the reception room a little bit about the efforts to match money to scientists who need money. A company called the Community of Science on the World Wide Web that I've been very active with, www.cos.com. And they have a collaboration between 700 universities and about 500,000 scientists who tell in first-person narratives what they would like to have funded. And then there are about 150 or 60 corporations who come in and look at that and find online, it's almost a dating service, if you will, between science and people who need scientists, and science and foundations and government agencies that want to fund science. So they offer a powerful use of this new technology to match business needs and academic skills. So I think the other dimension here is that we find ourselves in the NASD working to establish an institute on regulation, which we're doing at the Wharton School of Finance, so that we can bring a certification process to people that are working in the compliance aspects of the broker-dealer community. We think the collaboration with a university is the right way to do that, because the university is in the business of imparting knowledge and allows us to let them do what they do best, while we do what we do best. We actually can tell them what the need in the market is, and we can give them a certification with our brand name that is meaningful in terms of getting a job once you've been through that program. And that's can be both for people who want to get in the industry for the first time, and also for continuing education of people who are already in the industry. I do think that the pace of technological change is going to require us all to reinvent ourselves every 3 or 4 years, and I think we're going to find more and more ways and more needs for specific businesses and specific educational institutions to work together on specific programs. Yes, sir.
Said that articles say that about 80% of day traders lose all their investment, and the question is, do we wait for day traders to run out of money, or do you think that SEC will step in and try to control that great loss?
I think the answer is yes and yes. Here again, we are at that wonderful conundrum of personal freedom versus protective government. There is clearly a role for the broker-dealers to alert new people coming into the market of the risks of being in the market. But there is also a desire on my part, and probably on your part, not to be told what I do with my money. And I think if you look at the practical aspects of this, if someone, and this actually happened a few months ago, and we spent some time talking about it, someone just like me, or perhaps just like you, began to do quite a number of trades in one day, and they were classified by the brokerage firm's computer as a day trader. Well, I think I remember the specifics well enough to say that what they were doing was settling their estate and planning to move or something. They happened to do a lot of trades that day, and suddenly they found that they were classified as someone who needed to be specially monitored and have higher margin requirements and so forth. I don't think you'd like that a bit if someone came in and said, well, you know, we're going to really watch you carefully because we're not sure you know what you're doing. On the other hand, from our point of view at the NASD, we want to have a market that's trusted. And you're not going to trust our market if we let you get wiped out and you feel that somehow you weren't aware of the risks. So what we're doing with the industry, and by the way, the responsible firms are very much in favor of this, is increasing the amount of notification that we require for investors. We are increasing the responsibilities of the brokers to provide information in certain cases. And we are working with the brokerage firms to increase the margin requirements on stock. One of the big problems is that you can borrow money and it helps you make money on the upside, but it also accelerates your loss of money if the stocks go against you. And we think that the firms should look at restricting the use of loans to, which was what margin is, loans to investors for either particular classes of investors who can't afford the loss, or for particular types of securities which are highly volatile or speculative, or both. But we think that's better a decision at the brokerage firm's level than at our level or at the SEC's level or by federal law. So we're trying to find the right balance between these personal freedoms that we all enjoy and very legitimate concerns about people coming with some desperation to the market to try to get rich quick and losing everything. Yes.
Do you feel that NASDAQ or NASD fully understands or appreciates the extent of decimalization, and what would that mean?
Decimalization. Let me tell you a little bit about decimalization. There's nothing we would rather do than get rid of fractions. These are holdovers from pieces of 8, literally from when the Spanish dollar was a dependable currency, a trustworthy currency. It was what it purported to be. It was silver. And people cut them in halves and quarters and eighths, and we've been using them on Wall Street ever since. Well, in many ways, they're like this Y2K issue. There are fractions embedded in software all over Wall Street. So there's been a big effort, and needs to be a big effort, to test that all of those have been taken care of. But at NASDAQ, our problem is a little bit different. We, as you in your introduction said, have been facing this incredible growth in demand for our services. And we have, fortunately, been able to provide consistent, continuous availability of the market, even though I will assure you that we are like that proverbial duck that looks so smooth on the surface and is paddling hard underneath. We are adding routers and adding computers and adding disk drives and adding circuits basically every week. To keep up with the sharp increase in transactions that we have in the market. And we ran some tests the weekend before last in which and by the way, we've been running our decimalization system for about a year in the over-the-counter bulletin board, which is a place we could test it in real life without anybody noticing. And unfortunately, it doesn't test every aspect of our system, but it gave us a lot of insights. And so 2 weekends ago, we ran a big test on the capacity requirements of running fully decimalized NASDAQ. And what we found is that it took a lot more computer capacity when we ran the current volumes through than we had planned for. And we need to go back and do 2 things. We need to add some more physical capacity, as we say in the computer room, add some more iron. And we also need to go back and restructure some of the logic paths so that we're not thrashing the memory quite so we're not hitting the memory in and out of the memory system so often. And we need some time to do that. And we think it's by far more prudent for us, which we did this week in a letter to Chairman Levitt and in visits up on the Hill, to say, the responsible thing for us to do is to say, as much as we would like to have met the July 3rd date that we had all agreed on, it doesn't look like technically we're going to be able to do that. And we need to tell you this right away because lots of people are working and testing, and we have asked the SEC to delay for 6 months or so the introduction of decimals so that we can be sure of giving you that same high level of reliability even in the face of these 2,200,000,000 share days that you mentioned in your introduction. So it's really a technical issue for us, and we want to be very, very prudent about it.
I have one of those simple questions. You've talked about globalization. We know that the internet goes beyond national borders.
Yes.
What role do you see the NSD taking in the development and responsibility for some of the newer markets internationally, such as the former Soviet Union, or is there a role?
Yes, we think there is a role, and I want to put this in a context that may be a little different than you traditionally think about it. We come at this from 2 perspectives. We come at this from the perspective of building our own business. Like any other business, we're proud when the NASDAQ grows, and we want it to be profitable and thriving and doing good things as a business. But we also come to this issue with a national public policy perspective. And we believe that the United States has 2 things that are important. One is we have a financial services industry of which markets are a part that is incredibly valuable to the country. It's a big employer, and most importantly, it's that allocator of capital that I mentioned earlier. Secondly, we have a scale
that would allow us to bring the benefits of these equity markets to raise the standard of living around the world. Again, getting capital to entrepreneurs, allocating capital. Now, what do I mean by having scale? In the United States, we have so much money invested in equities that people like me, when I was a research analyst at Alex. Brown in the 70s, could afford to focus on a very narrow area. I spent my entire career focused on financing computer software companies. And when I started in the 70s, there weren't many of them. And I was able to say, well, I can gain an advantage and earn a living if I narrow my scope and learn all there is to know about investing in software companies. Well, we have that high level of specialization in industry after industry after industry. Now, what does this mean to the world market? It means that, and I was a practical example of this, it means that having spent a long time trying to figure out where value was in the U.S. software market, it was very easy for me to evaluate a French company like Business Objects, or a Canadian company like Cognos, or an Israeli company like Checkpoint, in the context of the business models that I established for my own analysis. Now, had I been a generalist operating in a smaller market, I could not have known as much about the software industry. So it would have been, to me, a more risky thing. I would have felt more risky, and my willingness to pay would have regressed to the mean. So generalists have to avoid risks that a specialist doesn't incur, because the specialist has the knowledge to know whether it's a risk or not. Well, this has a profound effect, and the Israeli high-tech industry is a good example of how this works. They can get a much higher price for their shares selling to specialists in the United States than they can to selling to generalists in Israel, because that's a much smaller market, and the financial community doesn't have this high level of specialization that we have. So we believe that we can make access to American growth companies much easier globally, and we've started NASDAQ Japan and NASDAQ Europe to do this. The idea is to tap what we believe are common human aspirations around the world. We think that people are pretty much the same. It's governments that are dramatically different around the world. And we believe that people want to save. They want their children to have a higher standard of living. They want their children to be well educated. They want to have good careers. And we believe that a lot of people around the world would like to be able to invest in these high quality growth stocks that happen to be booming in the United States. And so NASDAQ Europe and NASDAQ Japan will have as a first goal to make the costs of transactions as low as possible, and the information about these companies through our use of the World Wide Web as wide as possible. Now, we also would like to create a pan-European and a Japanese high-tech IPO market, because we believe that in those less equity-oriented cultures, and you'll remember from our earlier comments how much more equity-oriented we are, that there is a place for our style of risk-taking, our market format, to match entrepreneurs to savers in a way that will promote significant economic growth that's not now easily done in either Europe or Japan. In Japan, clubs are an important social phenomenon. There are clubs for everything. And we started the NASDAQ Japan Club with an idea of attracting people who might like to learn about raising capital on the NASDAQ. After we'd been open about 4 weeks, we had 4,000 entrepreneurs who joined. There's huge pent-up demand there for people. The traditional companies couldn't get on the Tokyo Stock Exchange until they'd been, the average one was 23 years in existence before it was able to tap the capital through the Tokyo Stock Exchange. Now, we believe our very presence has caused some good things to happen. The Tokyo Stock Exchange has created a second tier, a lower set of requirements to finance entrepreneurial companies. And that in itself, we think, is a healthy response. And we're pleased to, and we believe we were instrumental in triggering that as a competitive response. In Europe, we had started EASDAC a few years ago, and as a pan-European NASDAQ model. We had participated in the formation of EASDAC, and we were a minor shareholder, and we had helped them with their rules and their technology. That caused a response in Germany, France, and England to find markets that were national to support their entrepreneurs. We think pan-European is a better model because it taps a larger pool of liquidity, but even our initiatives and EASDAC's initiatives created a better situation for entrepreneurs and for capital formation just by our showing up and creating that, you could call it an immune system response in the body politic. So we believe there is a huge opportunity to globalize trading in the top 300 or 400 stocks around the world and to create this up from the bottom ability of entrepreneurs to finance their ideas.
Regulatory side.
I'm sorry?
On the regulatory side, on the other side of it?
Well, the regulatory side is complicated because, and thank goodness Chairman Levitt has begun to address this, we don't have anything in the enabling legislation of the SEC that's really designed to promote the growth of markets. It is fundamentally an investor protection model coming out of the crash of 1929, and the protections that the country developed have been significant and led to significant growth of the markets, but it's pretty much has stopped at the oceans. Now, the SEC has begun to address the issue of how are we as a country going to participate in the globalization of equity markets. The market, by the way, for wine is a truly multinational market. You can walk down here and buy wine from Argentina or France or Australia or anywhere you want. So a lot of product markets are global. Financial services markets are being addressed in the current World Trade Organization agendas. And fundamentally, that's insurance and banking. There's nothing on the WTO agenda that will put in place the multilateral agreements that we need to really have the true transnational trading. Let me take you through a little four-part analysis of what markets can and do together. Think of it as an American wedding cake with 4 layers. At the top, the smallest part is an unregulated piece, and we do that, and that's to trade information with each other. And you can go to the NASDAQ Hong Kong Stock Exchange website, and we'll see what we're trying to do to promote each other's information. At the second level is a regulated piece of the puzzle, and it's something that's well understood and done, and we've done it hundreds of times, and that's to dual list companies. The company has to take the initiative, and the company has to meet the rules of each market. But we have hundreds of companies in the United States that are dually listed in another market, and they trade separately. The third layer of this cake is what people think about when they talk about trading internationally, and it's illegal. And that's for a non-U.S. broker or a non-U.S. market to solicit sales, purchases from Americans, sales to Americans, or to act as an agent for someone else coming into this market. So that's the agency layer. And of course, the layer below that, where you really think of a globalized market, is also illegal, and that's for a foreign market or a foreign broker or a foreign security to be dealt with as principal in this market. So we don't have the ability to just simply include the Deutsche Börse or a German broker-dealer in the NASDAQ quote montage, even if they want to sell Intel and they've got the best price and the right quantity. That's verboten. We have the technical ability to do that right now. It's nothing to us to add another market maker. We have 70 or 80 market makers competing in Microsoft and Intel every day. And we could easily put Deutsche Börse in there, or one of the large German Dresdner Bank or something. Now, the way the large multinationals have gotten around that is they've created U.S. broker-dealer subsidiaries, and they come in and trade through their U.S. subsidiary. And that has worked to serve the world pretty well, but it's pretty high cost. So that's the framework we're working in. And the nice thing about the current situation is that the SEC a year or so ago went out and said to the country, how should we deal with this globalization effort? And they got a lot of comments back in, and I would expect they'll come out with an analysis of that sometime in the next year or so. They've also begun to force the hand of American markets to be more competitive in several ways. They've allowed international markets like TradePoint and the Bermuda Stock Exchange to have status as approved, SEC-approved markets. So they're sort of saying to the industry, start figuring this out, because they know, as we know, that hey, the European Common Market is not many times, but it's half again as large as the U.S. market. And if you were a German bank, for example, and you took a 20-year view, wouldn't you say that I have an advantage with 370 million people over America with 270 million people? And shouldn't the European Common Market ultimately be a larger market for equities than the U.S. market? Of course, if savings rates are high and all the other things that happen. So I think I could turn this argument and I could say, looking at it sort of ethnocentrically and say, well, America ought to be asserting itself internationally. I think that competitive model it's easy to get people excited about. I'd rather take the view that we can actually grow the pie around the world and everybody can prosper by having capital be able to be allocated millions of times a day to new ideas and new entrepreneurs. So, other questions? So, yes, ma'am.
We've read recently and heard speculation about the combination of New York Stock Exchange and NASDAQ, and just wondered your thoughts on that, and realistically if that's something that would happen in the future.
Well, as you saw in the paper, the New York Stock Exchange has had conversations with the NASDAQ, and the NASDAQ has said that it's not interested. We are in the middle of a very large effort to have a private placement, to sell shares in the NASDAQ to several classes of investors, primarily to the broker-dealer community that brings orders to the NASDAQ. We need to align the economic interests of the people that are creating the value in NASDAQ with those people. Right now, NASDAQ is owned by a nonprofit, the National Association of Securities Dealers. It's a Delaware membership corporation, and there's no direct link other than what we do in price reductions. No way for us to feed back benefit to the members other than the product or service that we sell and the price we sell it at. There have been efforts on the part of new exchange wannabes to have very narrow ownership, to have 4 or 5 large brokerage firms own what would become an exchange. And our arguments are quite simple at the public policy level. Does this country serve itself better by having broadly owned and broadly governed markets, or does it serve itself better having narrowly owned and narrowly governed markets? And I am very much on the side of having broadly owned, broad ownership participation, lots of transparency, and the incentive for many people to participate in an open system that welcomes more and more people. See, the fundamental difference between the NASDAQ and the traditional bourse model is that we're an inclusive market model. We're like the currency markets or the international bond markets. We say, if you've got product to sell, we'd like you to display it. You don't have to give it to someone else who has a monopoly in trading that stock in order to get that done. You can come in and compete, and that's why we have 60, 70, 80 market makers in the bigger stocks. And that's why the investor benefits from that raw competition for every trade. We don't compete once for a monopoly license. We compete in the NASDAQ on every trade. You've got to be the best on every trade in order to get that trade off if you're a dealer. It's a profoundly different business model, and we think we've got a very good business model for the country and for ourselves as a business. And we need to get this private placement finished in order to be sure that we don't fragment our market inadvertently by having it be more attractive to go start a new, narrowly owned market than to participate in a broadly owned and broadly governed market. Other questions? I thank you very much for having me.
Thank you very much, Al. It was very much appreciated. The seminar series is meant to be forward-looking, as we've said, and we've been blessed to have previous guest speakers, including such business leaders as Bob McCool of Mobil, Alan Herskowitz of SAIC, Lisa Ancilio of Intel, Greg Maffei of Microsoft, or formerly of Microsoft, and Dan Golden of NASA. Today, Al has provided us with his vision for the markets. I'm sure you'll agree that this seminar has been both useful to the members of the local business community and to our alumni. Now I'd like to introduce Bob Sigathy, the Dean of the School of Business Administration. Bob.
This will complete the series for this year, and I think it's an opportune time to show our appreciation for the people who actually run it, people who have done it. The series was started with a combination of a tremendous trio. One lady, Joanne Drury, who's right here, Mike Kelly, who's a member of NASDAQ, and Stuart Crist. And I think we ought to, let's give them a round of applause for this. Just one word for me. We're going to do this again. We're going to continue the series next year. We would like your inputs. I think, as I remember, I think they've handed you a little sheet. If you would put down on the sheet people you would like to hear, and even more important, people that you know that we can invite to this. As we open up this convention, we get there. We've set a great standard for ourselves. And I think we've ended this year on a high note. We want to start next year on a higher note. And to speak of that, you have, I think what you get is a ribbon that says Marymount University. But just to show a token of our appreciation, we want you to remember. Thank you all for joining us. We'll see you in the fall.
Well, it's my favorite.